Hello, everyone. This is Tom Casper with Lyons Wealth Management, and this is one of our educational pieces that we put together. This particular one is market facts and context surrounding return and performance. And this is it's a series of data points that are applicable to any and all investment portfolios, but I'm going to specifically drill down into the Lyons enhanced yield strategy and try to put some things into perspective by providing some context that will, I believe, be very helpful to properly align the way to both psychologically and mentally approach the strategy. So that way you can emotionally and psychologically be in a great position to let this really unique strategy thrive for you. Okay, so let's get into it. The mental approach to your account has to be of a different mindset. And that when I say a different mindset, what I'm really specifically referring to is that ever since people started investing money from the time that they were a kid till even today, the idea is to buy low and sell high. Buy a stock at $50, sell it at 75, make a profit, and I'm happy. Well, this strategy is designed to deliver cash flow. It's derived from yield. And what we are striving to do is to deliver a consistent, reliable, and measurable cash flow. This is the primary focus for the enhanced yield strategy. So in order for you to be successful, we've found that you have to become comfortable with the market ups and downs and realize that it's not the market ups and downs or whether the portfolio is in a positive position or a negative position. It's that we continually and consistently hit that dividend cash register every quarter. And here's what I'm getting at. So we like to use the example of a piece of real estate. So say that you own a piece of real estate, it's valued at $1 million, and you find someone who's willing to pay you between 120 and 150,000 a year in rental income. That piece of property could increase in value to $1.2 million or decrease in value to 700,000. But as long as we're receiving the cash flow, the value fluctuation is secondary. It's not as important as the cash flow. The cash flow is the number one goal and concern. So looking at that, understanding and knowing more about the market, some of the market history, is the knowledge that is really the mental power that you can control and use to control your emotions. And I'm going to be going through a bunch of facts here in the next series of slides that should really provide you with some great foundational basis that you can, kind of resort to or reflect on when your emotions do start to come up and they start to get the better of you. These pieces of knowledge and facts are priceless, and when it comes to reducing stress and anxiety. So when you look at, most people tend to, when they look at their account, they say, oh, well, this stock is up or down, or, oh, I have a portfolio of stocks. Well, it's really helpful to stop viewing positions in an account as owning stock. You do own stock. I mean, that's a literal thing. But what you're really effectively owning are good companies and businesses, and you own them through their publicly traded stocks. And from 1926 to 2020, S&P 500 companies have, on average, compounded at about 10%. I get that number from Ibbotson, if you're looking for the reference. And during the same time, the average inflation rate is 3%. Now, this is important because you grow, compound, and spend real dollars, and inflation takes that away. So that is a reduction of the effect on your wealth. So the net effect in terms of average real rate of return is 7%. And this is the number that determines your wealth and how much your wealth is going to compound by consistently over time on average moving forward. So keep in mind this net average real rate of return is 7%. This is going to be a benchmark that will become more important as we go through this presentation. So another thing that we must know and be prepared for and accept is that market corrections happen almost every single year. And a market correction is when the S&P 500 retreats from its highs and drops on average about 15%. This happens every year. So if we know this and anticipate it, no different than, hey, it's October and the leaves are falling. If you know that this is going to happen and you anticipate it, it's comforting to know that, hey, this is just an average market correction. It's not a big deal. And when it is anticipated, it's not shocking. And you have to assume it's going to happen. You have to expect it. And you can mentally and emotionally plan to ultimately ignore it. And I know that it's easy to say, hey, ignore a 15% downdraft, because people don't really feel 15%. But if you have $1 million portfolio and it's off by $150,000, well, you definitely feel $150,000. So again, keeping things in perspective, just know that it happens. But also, just like the leaves fall in October and it does snow in November and December, depending on where you live, of course, not here really in Florida, but knowing that it is going to snow, it doesn't mean that you're selling your barbecue grill. You're not taking your lawnmower out to the curb and throwing it in the trash. Well, why? Because you know that you're going to need these things next time spring and summer come around. So what comes next? Well, bear markets. Now, these are tough to ignore, and we understand that. But since World War II, on average, the S&P 500 will go down about a third of its value about every 5 to 7 years. And during both corrections and bear markets, your valuations will appear to go down in your account. It's not that they just appear, they actually do go down in your account, but they appear to go down in your account in value. And that's because if you just are patient, they will turn around and come back. We have always had a recovery after a bear market. We have always had a recovery after a severe and sharp correction. And being an equity investor requires the understanding of two facts that are self-evident. The first one, knowing and accepting that every year there can and will likely be a correction and your values are going to appear to go down 15%. And then also knowing and accepting that about every 5 years, we're going to have a bear market and your valuations could drop by a third. Now, if we know that that happens, well, it's going to be okay. Now, with the enhanced yield strategy, we do have these protective measures in to try to protect us from actually feeling and experiencing the down 15 or down much more. The average bear market's down about 27% to 35%, depending on which time frame slice you tend to look at from a window standpoint. But again, in the note here, due to the design of the yield program, we do have the aforementioned floors built into the portfolio as a way of protecting and trying to alleviate this from happening. But if you do have just a regular investment portfolio, yeah, just knowing these things, it's almost better to just stop opening your statements and just give yourself the time for everything to come back. Because so far, since the history of capitalism, it has never not come back. Okay, next. The appearance of loss is, again, sorry, I'm going to retrace this again, but the appearance of loss is knowing that the market's going to come back. So things are artificially being deflated. So case in point, and this is a really great case in point, but on March 9th of 2009, the bottom that was the date of the bottom of the great financial crisis. And in the 17 months to the day, the S&P was down 57% on that night's closing. And the violence of the stock market decline is mirrored in the recovery. So during the following 12 years, the S&P 500 compounded on average at 17%, which is an amazing feat to think that in 17 months, the market's down 57%, but over the next 12 years, it compounds at 17% on the way back. But here's where the rub comes in. You actually had to be there. And you had to be fully invested and not sitting in cash listening to doom and gloom on the TV. And a lot of people, in fact, most people that we've encountered, did find themselves having panicked sometime in the last quarter of the bear market and they were in a very heavy cash position, and then ultimately stayed in that cash position for probably a year following before they got fully invested. So the idea of owning great companies, and there are two sets of numbers that really need to be digested. The first set, great, and the reason why are that great companies grow in value. So to give you an idea, in 1961, the S&P 500 index was 68. Yes, just 68. It's a ridiculously small number. So and I'm using 1961 because that puts an investor's age at about 61, 62 years old today. And as of September 29th, 2022, the value at the time that I put this together, on September 29th, 2022, the value is 3,636. That's an increase of 53 times. So over the course of 61, over the course of 61 years, we've had a 53 times increase. Now, in 1961, the S&P earned $3.37 per share of the S&P 500's overall value. In 2021, in March, the S&P earned $203.88, and that's a 59x increase in earnings. And the reason I bring this up is because great companies grow their earnings through new markets, innovation, new products. They get more efficient, and this is the driving factor behind the growth. There's an important reason why I bring this up. So the second set of numbers that we want to look at is the relationship between the dividend, or the cash flow that's coming off the S&P, and the cost of living, i.e. inflation. Well, in 1961, the dividend of the S&P was $2.04. In 2021, the dividend yield, being specific, is $60. So the cash dividend during this time had gone up 30 times. So the reason this is important is because you take your income to the grocery store. It's what you use to pay for vacations and buy kids and grandkids gifts and helping out the family with college tuition or whatnot. That's the money you take home. So inflation eats away at that. And that's something that has to be taken into account when an investment portfolio is put together. So if we look at the dividends, we look at the increase of the dividends, and then we look at CPI, which is the bite of inflation that is taking away from that cash flow that you're getting. In 1961, the CPI was 30. In 2022, CPI is currently about 296. So inflation has increased by 9 times. But dividend growth, the growth of owning companies versus bonds, dividend growth has outpaced inflation by 6.5 times over the same period. I'll say that again. Dividend growth, owning good companies. Just by doing that, you're outpacing inflation by 6.5 times over the same period. So as a realization, the income, the real income, the stuff that you live on, generated by great companies grew by 30 times, and the CPI grew and expanded by 9 times. So the real return of the S&P as a whole is net at 7% after inflation since 1926. So this includes total return. This is the growth and the income, et cetera, et cetera. So to get this return, and this is where it gets interesting, is that you have to have weathered annual corrections of possibly 15% and bear markets of down 33, maybe plus more percent. And you had to stay fully invested during the 2000.com crash, stay fully invested during the great financial crisis, and not get out because you had to be there the whole time to get that 7%. So investing in great companies with consistent dividends is a natural offset to inflation to the tune of 6.5 times what the inflation rate is. And that's from 1961 to 2021. So how do you fold all this information into the enhanced yield strategy? Well, in the previous slide, we talked a little bit about the why behind our use of great dividend paying companies, but here are some more benefits. So in terms of return, the enhanced yield portfolio We target a dividend producing cash flow of between 12 to 15% net after fees, after margin expenses, et cetera. So think about this. Do you remember at the beginning I said, remember 7%? If we achieve this goal and achieve this target, it means that as an investor in the strategy, we can actually effectively beat the market by almost as much as 2 times on an average rolling basis. 2 times. And that's just from cash flow itself, which also means that if you're reinvesting the cash flow back into the portfolio, it's becoming even more efficient because we can strategically go in and buy at appropriate times when more opportunity is available. Either we buy the same great companies at lower prices, or we can diversify the portfolio and buy like opportunistically go buy, hey, this particular company's gone down in value and it's a great buying opportunity now because of the yield or the dividend yield is so attractive. Next is the risk mitigation. So unlike portfolios benchmarked to the S&P, where, like I said before, when you have corrections or bear markets of down 15% or down greater than 30%, so unlike portfolios benchmarked to the S&P 500, where you experience high levels of volatility, we are implementing and using collars to mitigate this downside risk and volatility. So that is where we have the ability to go in and show people through on interactive brokers the, hey, if the market were to be down overnight, say 20%, here's what your max loss would be. And that's a very unique distinguishing factor that we can provide that offers a lot of comfort and less sleepless nights, so to speak. And then third, it's tax smart. So remember, the dividends are not taxed as income like bond yields are. So if dividends are taxed at a favorable tax rate, and you may have heard one of our presentations, or actually me doing another presentation where I've outlined and distinguished between bond yield after tax and dividends after tax. There's actually a 30% price improvement by having the dividends as the source of cash flow and income versus having bond yield as cash flow and income. So one of the, and I'm sure everybody's seen this one too, but so the commonly asked question with yield is, with the downside protection and the upside and being able to, return the market's overall annual average net return to 7%, it sounds really good and it's almost too good to be true. What's the catch? Well, here's what is very transparent and straightforward, is that if an investor were to start with us and the market were to go down and continue to go down, there could be a situation where the portfolio value could drop as much as 15% as all the protective measures kick in. But if this were to occur and the levels were to stay declined for say 12 to 15 months, which has never happened in the history of ever with the equity markets, what we would do then is rely on the dividends to pull us back to even or very close in a worst case scenario. And if we're getting, if we're looking at a portfolio drop of say 15 to 18%, we can recoup that in 5 quarters of dividend payments if the market were to remain flat, which again, historically has never happened. So also given this scenario, the cash coming into the account could or would be reinvested back into these companies with a greater yield percentage. So if what was initially a 5% yield on a great company, if it drops precipitously in value, well, now that yield might very well be a 6.2% yield. It's the same great company, but the companies become more affordable, and hence, conversely, the yield goes up when the price goes down. So we own great companies at cheaper prices, and the yield is offset. So the other question that we get is, what if the companies reduce or cut their dividends? Well, since we tend to steer toward consistent dividend payers, we do have the ability, and if this were to happen and a company cuts a dividend or says we're not going to pay a dividend, we can actually exit that position and replace it with one of the many backups that we have in our on deck circle. So if we have to leave plan A, we immediately have plan B, which is more like plan A minus in the wings, just sitting ready and waiting. So that is it for the education presentation. If you have any questions, you'd like to talk about this more, please feel free to give us a call here at the office. And I thank you for your time, and I hope that this was helpful and educational for you.